Now, as we move into April, markets are entering one of the most frequently discussed seasonal periods of the year. Many financial media outlets regularly highlight that April has historically been one of the stronger months for US equities. So, why does the pattern exist? And today we're going to be looking at the data behind April's reputation, examine several major equity indices, and explore the structural factors that can help explain this tendency. So, first of all, why does April get attention? Now, April's reputation as a strong month for equities is not a recent observation. It's been widely cited by markets and analysts and financial media for years. And you can see here the S&P 500 looking over the last 98 years that April has been one of the strongest months. Now, several explanations are commonly cited for this. These include the end of tax-related selling pressure, fresh capital allocations after the first quarter, pension contributions, investment flows, as well as stabilization of positioning after any volatility that can sometimes accompany the start of the year. Now, none of these factors obviously guarantee positive returns, but together they help explain why April often attracts attention in seasonal analysis. If we begin with the S&P 500, April tends to show a constructive historical performance across multiple decades. If you look here, over the last 98 years, from the 1st of April through to the 1st of May, there's an average return of 1.10% and a 60% winning trade percentage. Now, you can sort of tweak around with that seasonal pattern and just see if you start sort of from the 6th of April, go into the 8th of May, you can slightly increase the winning trade percentage. And it's important to note, however, there are years where the seasonal pattern doesn't deliver. You can see here there's a number of years over the last sort of 98 years where there's been some significant falls during April. So it's an important reminder that seasonality describes tendencies, not guaranteeing definite outcomes. Still, the historical data does show that April often compares favorably compared to many other months in the calendar. Now, if we look at the Nasdaq 100, the tech-dominated stock index, this adds another layer. And because this index is more concentrated in growth and technology stocks, it can amplify broader equity trends. And you can see that in many years, the Nasdaq has shown similar or even stronger seasonal strength during April compared with the S&P 500. So if we compare the S&P 500 over the last 40 years, just so we're sort of comparing a like-for-like situation. So let's just change this so it's the last 40 years. Let's see, here we go. 41, that's close enough. You can see, okay, the average return is 1.36%. There's been a few years of greater than 10% returns in the S&P 500. But if you look at the 63% winning trade percentage, if you look at the Nasdaq over the last 40 years, you can see that there's been a number of outsized returns here, particularly in 2001. There was moves of over 20%, and the average return is 1.59%, just slightly higher than the S&P 500. Now, this shows that the seasonal tendency, it's not, confined to one specific sector of the market. The fact that we've seen it in the S&P 500 and the Nasdaq. So let's now bring in the small caps using the Russell 2000. Now, small cap stocks can sometimes diverge from large caps depending on liquidity and risk appetite. In some years, they participate really quite strongly in April rallies. In others, they lag behind. You can see that the pattern is definitely more choppy during this April period. And you can see that April is the fourth strongest month over the last 19 years, with July, November and December tending to be stronger. But if we just take a look here, that you can just see that even when the broader tendency exists, participation across different parts of the market can vary. You can see the average return here is 1.07%. 7%, sort of down from the Nasdaq's 1.59%, 1.36% over the last 19 years for the Russell 2000. Now, another useful exercise is to look inside the month itself. And many seasonal studies suggest that early to mid-April often capture a large portion of the month's historical gains. Later in April, the behaviour can become a little bit more mixed as markets begin to focus on upcoming earnings seasons, macroeconomic data releases, and then forward expectations for the next quarter. And that's why it's often helpful to look beyond monthly averages and examine the intra-month pattern as well. So if we take a look here at the S&P 500, if you look at the first 10 days of the month, you can see that the average return is just over 1.07%. And that's for the first 10 days of April. But if we look at the last 10 days of April, so if we go to the turn of the month and we take the first day of May and then we go back 10 days, that is now covering the last 10 days of April. We can see that the average return is actually negative 0.03%. So what we're seeing is that April has historically shown relatively strong performance for equities compared with many other months. But number one, it doesn't make it a guarantee. And secondly, there tends to be in the S&P 500 a stronger start to April than end of April. And you can see here that that first part of the month tends to be stronger. If we just take a look here at the Nasdaq as well and compare the Nasdaq, okay, the average return 1.34% for the first 10 days of April. And then if we just go and have a look here, the last 10 days of April, see again a negative return. So understanding seasonal tendencies like the April pattern can help investors frame expectations and recognize recurring behaviors in markets. But the goal of seasonal analysis is not prediction, it's perspective. And April is a really good reminder that markets often follow rhythms, even if those rhythms don't necessarily repeat perfectly each year.